The title of the panel changed slightly after our prep call when, after 45 minutes, I said, okay, what are we actually trying to get at here? And the gentleman to my right, Kevin, said, what is the point? And I said, that's probably about as valuable information as you can get. So let me go to my cue cards here, even though I think I have it off the top. But getting straight to that point, what is the point of bridging real-world assets on chain? It's not more cost-effective. It's not really more efficient at the moment, but we're all here doing it. We obviously think it's important. You know, is the current system that broken? Like, what inspires you? I guess we could start there, and we'll start with Kevin. Sorry.
Okay. So sorry, playing the question back, like basically, why are we doing this, or what do I think the point is?
You actually asked the question, what's the point? So,
all right.
This is on you, dude.
Fair enough. This is a tough way to start. Well, I would say, you know, we were actually just having this discussion back there about, you know, why public blockchains versus private blockchains, right? And I think there is a growing ethos among those who are not super risk averse for a bunch of different reasons, either as an institution or human beings, that like we understand that the future is on public blockchains, but really like why is that the case? And it kind of brought me back to a conversation I was having with someone at a top tier investment bank where they were basically shilling me their internal blockchain kind of like repo, like service. And after a 30-minute conversation, he kind of explained that they had saved $1 million in like kind of intra-company or intra-bank cross-border repo. To which I was like, that's a joke. Like $1 million on a trading desk in your business is sometimes a fat finger, right? So how could you expect that over time this like private blockchain that you've built is actually going to like have a positive ROI relative to all the development, all the time, all the risks that you guys are taking, right? But that's just one institution, right? Contrast that with IBM back in, I think, 2017 or something, calculated that the cost of reconciliation in the financial industry globally approached $1 trillion. And there are not like, there aren't 150 or 100 million like institutions out there, right? Or 10 million institutions out there. There's only a handful that are really the bulk of that cost. But what that tells me is basically having a bunch of different like private blockchains together is not really going to reduce the cost of reconciliation. It might reduce the cost of reconciliation intra-company, but in order for us to attack that 10% of financial GDP, that margin that we can compress through basically decentralized finance, or at least blockchain rails, is incredibly, like that's the opportunity. That's the opportunity that all of us building on public chains have to go after, because the cost of reconciliation is not linear, it's exponential. Every node, every financial institution that's involved in a transaction adds to that cost. And there's no way in the existing system to bring everyone into one private database or one private blockchain. We have to basically build that utility in a global shared database in order for us to go after that like huge opportunity. So I'll pause there, but that's...
So just a little bit of information. This is a public chain maxi panel. We are very much a public chain group up here. And then another thing, I'm gonna look at that Telegram chat at some point later on, and as you hear things, start coming up with questions, because I want to see at least a handful from the audience. So with that, we'll move over to Markus.
Sure, so let me attack the question from 3 angles. What is the blockchain, the public blockchain, good for? I mean, one thing that we all know is it's more decentralized. The thing is about real-world assets, it's very difficult to make a real-world asset more decentralized than the underlying base asset like ETH or Bitcoin. So I don't think that's the right way to think about it. But there are 2 other things that come to mind that are much, much more powerful. The first is just efficiency. And we've already heard a lot about that, obviously. Faster settlement times and the entire back office that can be saved is a really, really good argument to bring real assets on chain. But the other thing that I'm personally even more bullish on is frankly just the globalization aspect. I mean, right now, if you live in Greece and you're a farmer, you're just getting way, way worse rates if compared to a farmer that lives in Germany or in the US, for instance. And that's just fundamentally unfair. And thus, globalizing debt markets, or frankly, any financial market, is just a huge win for the world. Stablecoins also come to mind, right? Let's assume you live in Argentina and you have to fight crazy inflation. Diversifying away from that into a US dollar stablecoin, that's just something that cannot be done very easily and at the retail level right now. And that's something that really uniquely displays the benefits of a public blockchain.
Phil?
Well, I mean, I would certainly echo what Kevin said about private blockchains. I don't even understand why this concept even exists. If you want a private blockchain, it's much more efficient to just centralize your database. So I think what's happening in a lot of companies that are implementing these sorts of things to improve settlement layers in intra-company, it's really just a tech rewrite, and they're choosing to use a blockchain. I don't know, seems like a bad choice to me. But the extent to which people are willing to issue their assets onto open blockchains, onto public blockchains, that's where we have the opportunity to take advantage of the things Markus was talking about, like the idea of the globalization of these localized markets, which is, in fact, it's I think, critically important for the democratization of access to capital. And you need a single rail that's going to be interoperable around the world. It could be on different blockchains that they themselves are interoperable, but the capital markets around these types of assets is only growing. It's going to continue to grow. And there are challenges, right? I mean, one of the things that I'm focused on currently is trying to develop robust identity solutions to allow for these issued assets to be able to float around on an open blockchain, but in a context where the transference of these things is adhering to some standards of identity. The difference between how Bitcoin or Ethereum works is that that's a trustless asset that is moving around on a trustless database, i.e. a blockchain. But in the case of real-world assets, these are actually not trustless assets. These are issued assets by an issuer, and then they're choosing to use a trustless network to transfer that value around. And in doing so, that issuer, frankly, needs to make sure that inadvertently that Kim Jong-un doesn't become a shareholder, right? You need to know that every issuer of a security typically wants to be able to look at the stock record and see who holds my stock. Well, they're going to want to demand the same things for real world assets on blockchains. And so I think identity is kind of one of those missing pieces that people need to focus on, and people are focusing on. So.
Well, now that everything has been said and done, the only thing I can do is I have to disagree. Otherwise, I'm not going to add any content here. And I'm going to disagree with Kevin, who is smarter than I am, so I'm probably making a mistake here. But I don't think that we have a problem of efficiency in financial markets that much. Maybe it's because the bank I used to work at was pretty good with reconciliations. It could be that. But the problem of reconciliation, I think, doesn't require a blockchain in the first place. I remember when I traded interest rate swaps, we had something called SwapsWire. It was a centralized system where you would say what trades you did, and the other people would say what trades they did, and it had to match at the end of the day. Now, so we got agreement on that. But then it turned out that we didn't get agreement on the valuation of those derivatives after the fact. When rates evolved and someone had to send collateral back and forth, it's not like there was a single answer that was the right one, that everyone could agree on. In fact, Goldman is famous for having made upwards of $8 billion tricking the market into believing the right way of valuing was its own way. So that's more of a human coordination problem. I'm not sure that the blockchain solves that. To me, what's a lot more interesting is that if you go back to the roots of our industry, It's got to do with censorship resistance and the ability to be in control of your finances. Now, I'm not known as a crazy Bitcoin maximalist or anything like that. In fact, for the longest of times, I owned no crypto. People thought I was crazy. I mean, I suppose I was, because I'd be richer now. But I've always believed, though, in that ethos specifically. And I think that some of the efficiencies that we see actually go back to censorship resistance. And I'll use the example of intra-group financing, right? So you've got, let's say you're a big trading firm, you've got entities in different countries, and you need to, collateralize those entities in different ways at different times, in not just of the year, but also of the day. And if you are a crypto company and you've got different entities with different bank accounts, and you start doing that in a big way, and any big crypto trading firm does that in a big way, in the sense that there's, tens, if not hundreds of millions of dollars of exposures of money going back and forth between the entities, the banks are really going to start to ask questions. Unless you're at the same bank, just like everyone was all at Silvergate. We see how that turned out. So you just can't do it. Even if it's legitimate, they just won't let you do it. And it seems a little bit silly, but if you replace in your workflow the US dollar with USDC, suddenly
everything
it's
changes.
A breeze. Or Tether, I'm sorry.
Or
Phil.
Tether.
Yes,
yeah.
yes.
In
fact, I'm a big fan of Tether. I want the record to show that. So if you replace your US dollars with a stable coin, it just becomes a breeze. And I think that's fantastic. And that's just the tip of the iceberg. It's the tip of the iceberg because at the end of the day, financial markets today really suffer from a problem of access. And a lot of it has to do with the problem of identity that you brought up. But, by the time we solve that problem, we might all be dead. So I'd like to, in the meantime, maybe use the censorship resistance property of public blockchains to do that. Now, you also mentioned that assets, real-world assets, we want to know who the shareholders of this and that company are. And so there is still an element of, we do want to know who's behind it, so it can't be entirely censorship resistance. But I feel like, just like with USDC, the fact that it's pseudonymous gives you an element of, I hesitate to use the word plausible deniability, but the good thing is that when you have USDC, no one really knows that it's you that owns it, or it's difficult to figure out. And so the US government can't just go and say, all of the USDC or all of the Tether in existence, we poof it out of existence. We just destroy it. Because if they do that, they don't know if they're actually going after terrorists or after grandmothers who put their life savings in Tether and then Ondo or something like that, right? And so the fact that the ownership is a bit sort of diffused through ownership, not by accounts with your name on them, but just with your private key on them, I think that's actually quite a powerful way to take an asset that normally, let's say US government bonds or something like that, where you have a high degree of certainty around who owns what, and so the ability to sort of seize those assets, you turn that into something that's a bit more diffuse, and where you do get a bit of censorship resistance, it does fit like sleight of hand in a way, just like mortgage-backed securities are supposed to diversify the risk of the underlying mortgage. But I do feel like there really is something at play there. And what is nice is that we're finally able in our industry to reconcile an ethos of censorship resistance with also the fact that we all come from pretty well-known financial institutions. That's just who we are.
Okay, that was a very natural transition. So I'm going to go off script, I suppose, because we talked a lot about privacy, and I'll go back to what's the point? I feel like Jerry Seinfeld. What's the deal with? What's the point? Does on-chain finance really proliferate and matter if privacy does not? Is it a protocol? Is it a feature? Is it a requirement? And I think we have two folks who are spending a lot of time on that, and then two folks who are probably thinking a lot about that with their respective products. So I'm gonna let Phil open up with this one because why not?
So I think that when we think about identity, on blockchains, it's not really about, oh, hi, I'm Phil Potter, and this is my identity certificate, and I'm presenting it so that I can trade some tokenized Apple shares. That's not what it's about. It's really more about, well, frankly, it's about, I think, to Max's point, we want to the best of our ability, to preserve some amount of pseudonymity is really important, right? And I think that privacy is something that's very important. If I'm doing a transaction, the only probity there is really between me and the person I'm transacting with, right? So whatever is being sent back and forth, if there is some data, identity data that needs to be sent back and forth, shouldn't be viewable to everybody else in the world. Maybe the issuer has maybe it's a multi-sig thing where the issuer can decrypt it if they need to, or something to that effect. But I certainly think that when it comes down to securities trading on the open blockchain, I think that the middle ground, in my estimation, rests somewhere in this idea that I don't need to know who you are when I trade with you. I just need to know that I'm allowed to trade with you. And how does that happen? I mean, well, if it's a matter of like, well, in order to trade this security, you need to be a US-based accredited investor. Well, somebody can attest to the fact that I am that, and that somebody has attested to, some accounting firm perhaps has attested to the fact that my counterparty is that as well. I don't need to know his name. I just need to know that a reputable third party has attested to the veracity of their claim as being a US-based accredited investor. So I think that there's all kinds of ways to think about about identity. I think zero knowledge proofs is another exciting area that looks to solve this issue of like not necessarily revealing your information, but revealing metadata essentially about your information that's relevant for making sure that you're complying with all rules and regulations that frankly exists already for securities.
Markus, any takes of Mauve, which for the crowd is a shade of violet, which I found out backstage.
Yes, it is. Yes, it is.
I said stage. I got the whole Mauve. The thing is okay. So go ahead.
We're doing privacy preserving compliance, and the reason why we do it is because the customer wants it. Now, crypto is not the most customer-centric industry, I guess, but we do know that privacy is just a value that the average crypto user does not compromise on. So figuring out a technical solution, how to map something that's absolutely required by the government, let's be clear about that, and still preserve the identity and not have any PII leakage on chain is something that can be solved, that's solved by us, solved by others, using innovative solutions and technologies like zero knowledge proofs, but also others. And I think in that regard, the crypto industry can kind of eat the cake and keep it too. Ironically, we have all these like very long debates, and yes, there are certain trade-offs, right? For instance, if you are trading on an AML-compliant exchange, in the end, you need to have a way for governments to access the data. Now, obviously, we can create and have all kinds of checks and balances for that, but when push comes to shove and there's a subpoena coming in, you have to serve up the data. And there's no way around it. And that's also how traditional finance works. And frankly, that's also there for good reason. And then we come to the point of sanctions compliance and AML compliance in general. People die to further these sanctions. They are agreed upon at an international level. They have buy-in from almost every government around the world. And I always say, let's just pick the right hill to die on. And I think privacy preserving compliance is a hill to die on for the crypto community, but being against sanctions lists and any kind of AML, that's just a non-starter. And especially at the Real Assets Summit, I mean, we just couldn't even conceive of real assets trading on chain without any form of AML compliance.
Exactly. I mean, there's a reason why things like bearer bonds, bearer stock certificates are basically extinct, in the modern world. Right? If the idea that any jurisdiction in the world is somehow going to say, oh yeah, sure, you can pseudonymously or anonymously trade securities, that are these things that are subject to rules and regulations that are on our books already, like that, it's just not going to happen. So I think it's in the interest of the industry to come up with solutions and present them to regulators, present them to lawmakers and say, here's a better way. Instead of like, oh, here's a JPEG of my passport every time you want to send a a blockchain asset. There are better ways. I mean, people are working on this stuff, and it's happening.
Yeah, I do want to add one thing too, which is not on the personal perspective, which is a lot of what we're talking about right now, but even as an institutional investor, and this changes across different like market regimes, but in a liquid debt, like what I used to trade, asset-backed securities, CDOs and stuff like that, like when you are looking at debt is fundamentally different than equities or FX. It's non-fungible. Like these are different types of assets, right? So there might only be 12 million of a particular CUSIP out there. And if I'm a PIMCO and everybody knows that I have, multiple trillions of dollars to invest, and I go out and buy a $500,000 odd lot of this one CUSIP, if anybody else hears about it, they're going to be like, oh, wait a second, PIMCO's not underwriting this bond just for a $500,000 investment. They're going to go out and try to find the remaining 11.5. Right? So broker dealers, like what I used to do at Citi and the rest of my team did on the other side, we would go out and try to find that and basically source it and sell it to people, right? Or sell it back to PIMCO at a higher price and assess their willingness to pay, which they don't want to give me because they don't want me to know that it was them because they're PIMCO, right? And I think when we think about a lot of this stuff from individual perspective, it's also important to like recognize that from an institutional perspective, they're swimming in the same direction. And I think there's not a lot of vectors of like agreement between institutional and like kind of individual or retail participation. But I think this is like a really good place to kind of make that clear.
Okay. So I think that's a really excellent point. Is institutions want more privacy in their transactions. They should want what we're offering, basically.
This is exactly, I knew this one would get you guys going. I know, this is a good one. So a future state, there's a fully on-chain liquid market of every asset in the world using, ZK proofs for privacy. And that is a fantastic future. At this moment, we're all doing kind of different things. And I remember, you had a promising graduate degree from Harvard, and you decided to abandon that for this crazy world. And the initial conversations we had about disrupting, the world of, at that point, structured finance, structured credit, you had a grander vision. So the idea of what you thought at that point in time, which is about a year and a half ago now, roughly, versus what you have in process, in structure today, how you're deploying capital on chain. Where do you think that is with respect to what your ultimate optimal state of financial markets looks like on chain? I'm going to open that to you, and then we can kind of go down the stack. It probably is relevant for Max as well, but just given obviously the fund that's up and running and what you guys have been doing, full disclosure, very proud and happy LP. I think there's a few of us on the stage here. Curious where you think we are in that grand scheme.
Simultaneously close and very far, I would say. And I think where we're close is everybody here is working on some individual component of an end-to-end financial transaction, right? Because if you think about buying a stock on an exchange or whatever, you just think about execution. But the reality is any investment is a relationship with that asset. Like in credit, like I lend this money, I must build the infrastructure to go and get it back over the course of 10, 20, 30 years, right? And that's an entire process. And so a lot of what's been built today is basically serve yourself like infrastructure or applications of which we, in order to run our process of issuing CLOs on Ethereum, like we had to build this entire service around what was available. And I think there's a growing realization from builders in the space that it's not enough to be just a technology company. Like you have to be a services company. Like if you look at open source companies and what has been built on top of it, like Red Hat, for example. Red Hat takes open source Linux foundational like primitives, basically packages it together into a 540 megabyte zip file, and then sells you customer service, sells you documentation, right? That's where open source ecosystems or architecture is going to like go to. It's a service provider piecing together the best pieces available to allow somebody to execute this financial relationship using these types of new rails. And there we're very far. because a lot of pieces still need to be built. Privacy, on and off ramps, like the ability to underwrite, like et cetera. But I think where we're close is it's very clear even from today that there are a lot of people building these pieces, right? And the beauty of doing it in a public blockchain versus a private one is that you get to stand on the shoulders of everyone else, right? Like we didn't do what we are doing alone. We use many different service providers, and that's only possible because we're in an interoperable environment. And I think, yeah, that's like why I'm still super excited about the future, but I think, we have a long way to go.
So we're like 5% of the way there?
I'd say 40.
40. That's substantially higher than I thought. Okay. Anyone else want to take a crack at this?
Yeah, I agree with something, which is that it would be sad if all we created were technology companies. I think in this environment, if you just want to be a technology platform and not get your hands dirty, then you're lazy, you're boring, it's cowardly. Because what we want to recreate, if we go back to that premise that I really like, censorship resistance, is that we want to have the same suite of financial services on chain as we would normally benefit or can't benefit from in TradFi. And so that requires the allocation of capital, credit decisions. It requires that we do everything that TradFi do, except we change the rails. Because the rails that we have are better from technological, but also philosophical standpoints. So that's quite important. And I see a lot of projects, they just want to be a platform, they want other people to do the dirty work. And I think that's misguided because, as always, and we've seen that through the different cycles of crypto, the most money to be made or the most value to be created is at those intersections where it's quite unclear whether what you're doing is, on what side of the gray line it is. And I love Tether. Again, I bought a lot of Tether in the last DPEG. But some of the value that you created lies at that intersection where you created an asset that essentially anyone can own, but you put some constraint around it such that it does work. Like you're not going to jail, but basically anyone can hold it. And so that means that you managed to create a product that, from an AML perspective, has convinced enough of the authorities that it's still up and running, but at the same time, is seen, I'm sorry to say, it kind of is a bearer asset. You said bearer assets are more or less forbidden, but actually Tether is a nice bearer asset.
I mean, it is, except when you want to on-ramp and off-ramp, and that is what current regulation allows. I'm not confident that it will continue to be allowed and going forward. I mean, I think that regulators are catching up. They're eventually going to say, I mean, look, the travel rule thing just went into effect in the UK. It's going to be enforced eventually here in the United States. I think that people that are in the business of issuing stablecoin assets need to get ahead of the curve and offer up some kind of opt-in identity solution to the extent to which you're dealing with, U.S. nationals or European nationals or what have you. I will say, though, there is another feature to RWAs or issued assets on the blockchain that, and relevant to my experience at Tether, is that when you're dealing with trustless assets like Bitcoin or Ethereum, it all comes down to this private key, right? And boy, oh boy, if you've got a lot of money sitting in Ethereum or Bitcoin, it's a little nerve-wracking to keep track of that private key. Oh, do I get a little hardware wallet? Do I get this steel thing and engrave my seed phrase? Do I bury it somewhere? Do I break it in half and bury it in 2 locations? Who gets to know where those things are? Do I need 2 lawyers now? I mean, like this, it's a little nerve-wracking. And people lose their private keys all the time. People get hacked all the time. But with issued assets, the issuer can nullify and reissue the asset. It's happened at Tether many, many times where we've gotten a request from law enforcement or from an exchange, or a hack occurred or what have you, and we can freeze the assets on chain. We can do an investigation, find out what's going on. Oh, yeah, well, those were stolen. Okay, invalidate those, reissue them to the other person. So now we've completely changed the security model around real world assets, because the idea that not your keys, not your assets, that idea only applies to trustless assets that are native to blockchains. That is total fantasy world in terms of what happens in real courts in real jurisdictions around the world where the companies that are issuing these assets are governed. So that's an important distinction.
I would add, just from an American perspective, it's not a bug, it's a feature. I mean, one of the reasons why everybody is moving to America, trying to start business here, is because there's so much trust in the government. So if you have US-based stablecoins and you have trust in the rule of law in the US, what better environment to spawn a real-world asset industry that has the capability to reissue assets?
Europe, what better environment? Easy.
I mean, comparable.
There are like one or two other places. I would say, granted, Europe is also one of those. But when it comes to the rule of law, the US, I think in all public international service is always like near the top. So, yeah.
Okay, I have a list of questions here. So, by the way, we're at about 14 minutes. I have lost access to the Telegram chat. So, to the extent anyone wants to ask questions, you can start asking questions in the next few minutes. So if I see a hand raised, we'll cut. Okay, there we go. Wow, that was fast. Ah.
Pete, I can ask it for you if that's yeah. I'll do it. All right, this question's from Pete. Yeah, this question's from Pete Lucas. Which cohort will realize the biggest benefits of on-chain finance? Institutions or individuals? Or in other words, should real-world asset operators focus on use cases for the institution or the individual?
I had a really hard time making that out. Sorry.
Okay. Which cohort will realize the biggest benefits of on-chain finance? Institutions or investors? Or institutions or individuals, excuse me.
Well, I suppose we're trying to capture as much of the pie as we can, which is only natural. But I do hope that there will be plenty of benefits for the end investors. In fact, one of the big reasons that I do what I do at my company is that we see a lot of stranded assets in the ecosystem. A lot of it tethered to a greater extent than USDC, because just people who have the USDC or the tether acquired in very legitimate ways, but find it difficult to go back into the fold of traditional finance. Even myself, I get crazy questions all the time from the banks. And so from that perspective, using a product like Ondo has been a boon for me, because I've just made peace with the fact that any money, any personal wealth that I have within crypto is going to be there essentially forever. And so I need to do two things. I need to grow it. So now that there's products like Ondo and others, I can do that. And two, I need to spend it. And that's why I guess we've got lots of credit cards and things like that. Diversify it, exactly. And so I get a lot of benefit from that. But we also need to be realistic that everyone's trying to make a living.
I'll actually state something here. I mean, I think in my situation as an investor, as a user, and for example, BlockTower's credit fund, right? They're benefiting by being able to build an asset management firm on a very unique situation in the market and build a credit business on the back of that. I, as an investor or a user of that, have benefited immensely by being able to benefit from, on-chain finance and being able to tap into different capital pools and creating fungibility between on-chain and off-chain assets that didn't exist previously.
Yeah, I think one other thing I would say too is that the immediate use case, I think, for any sort of like financial rail is probably more oriented towards institutions. Like institutions have a higher degree of sophistication and also reporting and regulatory requirements that make this technology uniquely appealing for them versus a retail investor who, may have access to money market funds in various different types of off-chain brokerage accounts, right? And then moving money on-chain, going through the friction, that's very challenging. But these things are very, very tied together. Institutions intermediate like financial transactions in the real world, of which users, people like us, like regular people, are the beneficiaries, right? Or the recipients on the other side. So for example, like today, going back to PIMCO, for example, like if they're buying an agency mortgage-backed security, effectively buying or lending money to anyone here who has a mortgage, right? They're getting maybe something today like 6.5%, right? But the underlying mortgages may be closer to 7.5% to 8%. So what does that mean for us, right? When we go and we get a bank, or we go to a bank and we are looking for a mortgage, they're going to say 8%. Great. PIMCO on the other side is maybe not happy about it, but they're willing to purchase at 6.5%. Where is that other 1.5% going, right? Like 25 basis points of it is going to a servicing fee, 49 basis points of it is going to a guarantee fee, basically the cost of reinsurance, like from the agencies like here in the United States. But that remaining 75 basis points, sorry about that, that remaining 75 basis points is the friction, is the time that they have to basically pool assets, borrow money via warehouse lines, like execute a transaction, pay all these origination fees for securitizations, like do all of the, pay payroll, pay compliance, all of these different things. And I mean, our fund is already proving it to ourselves that we can collapse all of that into basically a fraction, a block, right? And so does that mean that in the future, if we execute this technology at a higher level, that we can basically eliminate that 75 basis point like gap, that friction that exists in the market? Like, I fundamentally believe the answer is yes. What does that result in? That means that when you go to get a mortgage, it's not at 8% anymore, right? It's 7.625%. And that's a fundamentally different, like that's a huge difference for people. And so for me, yeah, just going back to the efficiency thing, not to like beat a dead horse, like I think to me, that's the use case that I, as an institutional issuer of CLOs, would want to see. And ultimately, I think it has this benefit for society, which is, by the way, what we should be telling regulators, because like it's real.
And the institutions, they work for the general population as well. What are they? Insurers, pension funds? Who's on the back of that? It's you and I. So the more efficiencies they can unlock, the lower they lower their fees, because it's a competitive market. So when institutions benefit, it's not like they benefit in a vacuum and enrich some kind of diffuse shareholdings. It's not the case. It also comes back to us.
Yeah, and I mean, a 50 basis point reduction in cost of capital for the world is substantial. Yeah.
Think about the democratizing aspect of DeFi. I mean, why are Uniswap pools currently not profitable for many LPs? Well, because we democratized the LPing itself, and now maybe it doesn't like hit the hurdle rate of certain market makers, but hey, for consumers, the hurdle rate is very different. And in the same vein, we're going to democratize everything, the lending, the borrowing, and in the end, I think most of those profits are going to be competed away.
So it sounds like the answer to the question is the user ultimately, but the institution in the interim, and at some point both.
I mean, it takes some time, right?
Yeah. Okay. I think that's a clear answer-ish. What else do we have there?
Next question. This is coming from Kianga. For the participants excited about public, which sounds like all of us are, how are you managing the risk of decentralized governance? In DeFi or even L1 like Ethereum, you have unpredictable future states. Forking ability by non-institutions, anonymous forces. How are you understanding this risk and planning around it?
I mean, I would say that I don't feel like decentralized governance really has any substantial role in the issuance of real-world assets on a blockchain. Sure, people can experiment with DAOs and this kind of thing, and why would you want decentralized governance? Well, it's because people want to remain anonymous around the managing of those assets. That's the only reason why something like that would exist. And those will be pockets of these experiments out there, mostly around the managing of a pool of trustless assets, but not real-world assets. I mean, it will be it's a sideshow. It's my estimation.
I'm going to reframe the question. Yeah, Kianga.
Kianga, hold on one second.
I mean, I just want to push back a little bit on that. If you even just think about Ethereum as the network where you're settling, so to the extent we're excited about public because of the interoperability and where your real assets ultimately are going to flow. even take Bitcoin, although that's not the EVM, but these public networks are subject to a kind of decentralized governance force in terms of how that state of that network may change in the future. And so it's a little bit broader of a question than just DAOs. And I know Kevin, has some experience with MakerDAO in terms of like where governance can be very relevant to how your assets as an issuer ultimately can trade or get shut down, or so I just want to just maybe add some context to the question because I haven't heard anyone this entire day talk about governance, and I think it's very relevant, it's the elephant in the room, if there's going to be a public future or any kind of free flowing of these assets and liquidity in the market. There is this other thing that's happening, which are the decisions about the technology, about the platforms that will be your ultimate settlement layer. So I'm just wondering how all of you all are thinking or impacted about that, if you are, and sort of,
Well, in that context, certainly, if you're talking about the consensus layer and the developers that are upgrading the network and or maybe changing rules over time and things like that, well, there are, I guess, certain existential risks associated with that. But experience has shown so far that at least with Bitcoin and Ethereum, it's been a well-managed process. I do think that when you talk about something like Maker, again, that's something where there's people who are looking to preserve, anonymity through the holding of a token and doing governance that way. Let's assume you took anonymity out of it. Well, yes, I mean, you are talking about a DeFi protocol where people are putting in trustless assets and trying to pull out, say, a pegged asset like, DAI. And yes, DAOs are useful for that, but again, that's not really, it's a simulacrum of a real world asset. It's not really a dollar, right? So.
I also
and indeed, I think the problems that you would have when it comes to governance is with trustless, composable assets where the failure of one layer triggers cascading failures.
Yes, that's a
but in most of what we do or purport to do, there's the ability at the end of the day to burn what you created and remint it somewhere else. And I mean, it makes some of us less comfortable because it gives a lot of power to the sponsor of the real world asset or the tokenization, but it might actually be a necessity, be it with regulators or others. It kind of goes back to also the fact that what happens if you lose your keys? Well, for many reasons, we, it appears, need to maintain that level of control that if something goes really wrong, then we're able to just destroy what was created because it's broken and easily recreate it somewhere else.
Yeah, and just to answer your question directly about like building in this space and thinking about this uncertainty and what do we do, I think ultimately we have to, at BlockTower Credit in particular, but also just anyone using this technology, like has to try to avoid lock-in as long as possible, right? Like everything that's underneath the services that we provide basically to our LPs needs to be modular or as modular as possible. Otherwise, because we're not here to be ideologues, right, about a particular chain or a particular way of doing things. I obviously have my like political bends, but that's not what my fiduciary duty is. And so the way that we need to operate is basically abstract as much of that away from our day-to-day operations, which is probably not what any builder wants to hear. But if you're not considering that as a service provider, you're doing yourself a disservice. And also, that's not ever going to be acceptable by an institution, right? Imagine an institution saying, okay, we've migrated everything from mainframes over to a cloud, and now we're on AWS and we're shit out of luck if we want to go to a different, provider, right? And I think for us, that's how we tangibly approach building our business.
All right, we've got 1 minute left. I guess I'll take a crack at the last question for you guys. What do you think is the most critical piece of innovation that gets us to the next mass adoption cycle for RWA? And you have to pick one and keep it under, 20 seconds because we're running tight.
Custodian with an on and off ramp built in.
Biased, but I think programmable compliance to comply with 195 countries and their laws.
It's identity, self-sovereign, decentralized identity?
I would say what we're doing now needs to be done in transferable form. We need to be able to move the stuff that we create around more easily for a market to emerge.
20 seconds to spare. Okay, thank you, everybody.